Well, these are heady times in much of rural America. Commodity prices are at an all-time high, and here in Oklahoma, the oil patch is booming. Our state's two largest industries, big oil and big agriculture, have seen booms before, only to see them end with a bust. Today, we begin looking at the fear that there's always a bust trailing every boom.
The fact remains Oklahoma is in an oil and gas boom.
You know, I have no worries at all about the ability to sell natural gas. It's the cleanest burning fuel, so the demand for natural gas is strong.
CEO of Devon Energy, Larry Nichols, says the latest energy surge is not only helping major cities like Oklahoma City, but also rural areas of the state.
That's where we drill the oil and gas wells. That's where we hire people to work. And that has caused a really significant boom in the economies of rural Oklahoma. And when you discover oil and gas, you're then producing royalties, and those royalties are going to the farmers and ranchers, which is making it that much easier for them to pursue their own farming and ranching business.
And while a select number of farmers and ranchers benefit from royalties, all depend on good prices and a good crop to continue their livelihood.
Our prices have ranged from $8 to $11.75.
Wow. Have you ever seen it at $11.75 before?
Never.
David Turner cuts wheat with his son Grant just south of Oklahoma City. Current wheat prices have reached all-time highs, and this year the Turners are prepared.
We need another combine because we're cutting more wheat this year than we did last year, and we've seen what jam we got in last year, and last year another combine would have paid for itself.
A tall order when a new combine can run as high as $250,000. Something Earl Livingston of Livingston Machinery says isn't stopping farmers from getting the equipment they need to bring in this year's crop.
So we've been really lucky to be one of the dealers that, that has been able to stay really busy all spring. And the equipment, new equipment's been short, and so we had lots of good used equipment that was reconditioned, so we've been fortunate enough to move a lot of that.
Yet it is the fuel to run these machines that is cutting into profits.
It costs them $475 a day to run this machine with fuel.
Prices of fuel last year compared to this year is just about doubled, so it takes us double input cost every day to run these combines and trucks.
The Turners look to recover their inputs for this year's crop, but it is next year's that is most concerning.
Next year is going to be the challenge with fuel and fertilizer where it's at. Trying to figure out how you're going to have so much money in it in the beginning.
Yeah.
And who knows if wheat's going to hold.
And because Oklahoma wheat competes on a global market, the price of wheat depends on what the rest of the nation and the world produces. Economist Mike Dix.
If we have a really good harvest, price will come down. If we have an average harvest, price will stay about the same, and if we have a poor harvest, price could shoot way up again.
Which is the basic supply and demand model, but figure in costly inputs, and producers and the communities that depend on this crop could be financially out of pocket. Mark Hodges with the Oklahoma Wheat Commission.
Had we had the kind of inputs cost that we have today with fertilizer and fuel, if that would have been true last year and last year's crop, when we had a crop failure in the central part of Oklahoma up into central Kansas, we would have lost a lot of producers, and we would have lost a lot of elevators as well, because they don't make the kind of margins, they don't have the kind of assets they need to keep them in business to go back and put that next crop in, so there's not a financial institution that's going to back them.
A case very similar to the agricultural bust in the early 80s, and while most expect crop prices to drop, the cost of fuel could stay at its present level.
So with all of these things in place, while we can't say for certain what will happen, I think we can say for certain what the framework of the problem is going to be for the next several years, and that is that we are going to have increasing volatility in the food and fiber ag sector. We are going to have more economic uncertainty in the economy as a whole, but especially in agriculture, and we're going to have less stability, especially in the ag sector and perhaps in the general economic sector.
Public policy specialist Larry Sanders says those factors, combined with tighter banking controls and less governmental support, could very well mean dark skies on the horizon for Oklahoma ag producers.
And joining me now is our Brian Bindley. So if we've seen this cycle before, what makes this different than the 1970s and 80s when the boom was followed up by the bust?
Well, in some ways it's not that different. If you look at the comparison, land prices were rising, commodities and fuel were at all-time highs, and the U.S. dollar was low. All of this we're seeing today. Now, the government was also pushing for more food in the 70s, and here recently we've seen a push for corn-based alternative fuels. But where we are different is the structure of the farm economy. Since the 70s, there are fewer farms. Bigger farms are controlling the market, with smaller farms depending on some sort of off-farm income. When the bust did occur in the 80s, farmers could fall back on manufacturing jobs. Unfortunately, since then, a lot of U.S. manufacturing has moved overseas.
So once again, we are in a global economy and feeling its effects.
It is that increase in global demand that appears to be one of the biggest differences. Thanks to technology and globalization, more countries are producing commodities and competing with the U.S.
So while farmers can't control the price of fuel, what can they do to prepare?
Well, talking to some of the producers, one thing I hear is no-till cultivation. Essentially, this would save them a pass around the field to till up the ground for planting. However, this method could result in the application of more fertilizer and chemicals. Ultimately, it's a matter of taking a calculated risk based on the performance of a farmer's particular field, watching the markets, and knowing what to plant and when to plant.